Good morning. Welcome to the Eastman Financial Report. I'm Dan Eastman, your host, and today is Tuesday, July 22nd, 2025. Thank you so much for tuning in. As always, we appreciate your viewership here at the Eastman Financial Report and across all of the fine programming you see throughout the day on Worldview Tube, and you can hear on Worldview Radio. So we appreciate the fact that you take time out of your busy schedule to tune in and hear what we have to say, because as you know, we started broadcasting way back in the year 2006 with the idea that we would bring news and information to the great marketplace of ideas from a Christian perspective. And of course, since 2006, that great marketplace of ideas has been expanding exponentially. And there are many, many voices today in the great marketplace of ideas. All the news media, the mainstream media, the broadcasts, the podcasts, all of this information comes together on a daily basis where people are expressing their thoughts and opinions on newsworthy issues of the day. And it's important for us to be in that mix on a regular basis, on a daily basis, because we bring a Christian worldview to that marketplace of ideas. And that's something you're not going to hear from a lot of other broadcasters. So we're sort of in a unique and interesting niche position. And this is our ministry, our mission, and our effort. Our goal is to be able to bring newsworthy items into that marketplace from a Christian perspective, and that makes all the difference. So if you'd like to help us in that ministry, you can certainly do that. You can go to worldviewfoundation.com and you can make a donation. The website is on the bottom of the screen right now, WVW Foundation or worldviewfoundation.com. Takes you right there. Or you can use the convenient QR code as well, and that'll take you with your smartphone and take you right to the website. But if you make a donation, it helps us because it helps, as you know, we don't charge a paywall or subscription for our information. We bring this information to that great marketplace of ideas free of charge because it's our ministry. Just like the apostles of old back in 2,000 years ago, Saints Peter and Paul didn't charge to hear the gospel. They spread it. It was a gift freely given. And we do the same thing. We want our Christian worldview front and center, and we do that without a paywall or subscription because of donors such as yourself. So if you'd like to make a donation, you can make a one-time donation, and that's always very much appreciated and helpful. You can also sign up for repeat donations, and what that does is it tends to flatten our revenue curve so we can better match our cost to our revenue, and we can continue to offer content for free. And that's the beautiful thing about it. If you're watching me right now, you're obviously not paying a subscription fee. You are watching this content free of charge, and we can do that because of generous donations from viewers such as yourselves. You can also help us in our ministry by doing business with the companies you see advertising on our network throughout the day. We don't sell blocks of advertising time to companies. We partner with companies that we know and trust, and when you do business with them, you buy their goods and services, a small portion of those proceeds comes back to the network in the form of a donation or a commission, and that also helps us keep our revenue line secure so that we can continue to offer our content. There's a third way to help us out, and this is sort of new. It's very interesting. If you go to worldviewtube.com/vault, you can subscribe to the vault. Here's the website right on the bottom, worldviewtube.com/vault. You can subscribe to the vault service, and there's a little fee in charge. But what you'll have is real-time, on-demand access to all of Brandon Howe's ministerial works, his books, the seminars, the conferences, all the videotapes. We have interviews from great Christian thought leaders, some of whom have joined the heavenly host. But all of those thoughts and interviews are captured for posterity in the vault. You can also see copies or the reruns of the Eastman Financial Report if you're so inclined. There's a lot of content in the vault. It's on demand, so if you're sitting around 2 o'clock in the morning and you can't sleep and you're a member of the vault, you can go in and see some really interesting content, and you'll know that that subscription price, again, helps us keep our ministry alive and fresh and current in the great marketplace of ideas. So you can make a donation, or you can do business with the people you see advertising on our network, and you can subscribe to the vault, or you can do all three. But in any event, we appreciate first and foremost your viewership, and then secondly, your assistance in helping us keep this ministry fresh and alive and very much no charge in the great marketplace of ideas. So thank you for that. I want to talk about the news again today. And of course, as I pointed out yesterday, this is a slow time of the year for economic news and financial news, except we are entering into earnings season. And I spent most of yesterday's lecture explaining what earnings season is all about. And the summary today is, of course, that 4 times a year, publicly traded companies will publish financial statements, income statement, balance sheet, and they will, in many instances, do an investor call as well, where you have a chance to dial in, listen, and there is a public discussion by the chief executive officer and chief financial officer that talk about the results, whether they hit their benchmarks or not, and what their forward-looking ideas are for the next quarter. And of course, those are highly regulated, because what the SEC and the securities regulators don't want are companies going out and promoting their stock and hyping things up and creating excitement in the markets where people invest in the stock only to find out it was smoke and mirrors. So it's all regulated. And there's also personal risk involved to the CEO and the CFO if these executives overstate or fail to state a material fact or misstate a material fact. There's problems with that. So those investor calls are usually very, very carefully structured, and there's always lawyers sitting in the phone listening to make sure that the corporate executives don't get too far ahead of their skis. But that's the process of earnings season. And what happens is the companies will announce their quarterly earnings, whether they're up or whether they're down. And that does, in fact, impact the market share, because the markets, I talked about the great marketplace of ideas, and that's what we do on a daily basis. We bring forth the news from a Christian perspective into that marketplace of ideas, and people make decisions based upon what they hear us and other participants say. Now, there's no money exchange. I mean, the marketplace of ideas is basically where we get all our news. It's free. Everybody listens to whatever source, and it's not a security, it's not an investment. But when you get into the investment world where people are actually investing other people's money or their own money, those statements matter. And they matter because of the 1933 Act, which makes it illegal to not tell the truth or to misstate a material fact or to fail to state a material fact. So when we go into earnings season, it's an important time because we want to see how the companies have done financially, and we want to get some sense of where they're going in the future. Should we buy more? Should we sell? What do we do? How do we adjust our portfolio? And that's why that information is regulated. And it's sort of a dance. It's been going on for decades, but it is how we report in the United States. Now, if you go to Europe and other countries, they report semi-annually, which is twice per year. They don't report quarterly. In the United States, we want information 4 times a year. In Europe, the companies, they report twice a year. And of course, our perspective, our regulatory perspective, is that more information is better than less. Now, it's no small thing when you're the CFO, the chief financial officer of a great big publicly traded company, to be able to add up all the numbers every 3 months and then put out a report, which is highly scrutinized by the investment community as well as the regulators. And that's a big job, and it takes a lot of resources to do it. It's easier today with digital technology, but it's still a very important thing that when you do your quarterly reporting, it is going to have an impact on your stock value. Now, the unscrupulous, of course, will go out and talk about things that would make the company appear to be headed for the moon, and you want to get on today, and the stock will go up. But the more cautious companies understand that perhaps just going out there and telling the truth is probably a very prudent thing. And that's basically how Wall Street operates. And most of the information you hear tends to be very accurate because of Sarbanes-Oxley and other bills that make it personal liability for the CFO and the CEO if they don't tell the truth. So it's a very orchestrated dance, and it's very standardized. So that's why if you invest in public shares of any company, you will want to pay very close attention to the quarterly financial reports and any information that the company puts out. Now, big companies are not required to have an earnings call. You're not required to do that, but a lot of companies do, especially if their stock is broadly held, or perhaps if there are some big investors that are holding your stock in the larger percentages, 5 or 10%, you will want to communicate clearly and accurately because there are potential to see change of control, or a large shareholder can be a thorn in the side of somebody who's not telling the truth on Wall Street. So it's a real process, but that's why we hear about earnings season. And of course, the stock prices become very volatile during earnings season because of the information that's coming out, not only the written word that's published on the company's website and standardized reporting sites, but also the oral communications with these calls, and always looking for information that will give some indication, is the price going up or is the price coming down? And that's what financial analysts do. And that's the market that the corporate communicators are communicating into, is a group of very sophisticated people who spend a lot of time thinking about not only the companies they follow, but also companies in general. And when they hear things that don't align with their general perception of how corporate management should be working, or corporate growth or corporate contraction, whatever, that has an impact on the price. Because if the analysts are not liking what they're hearing or reading, they are pushing the sell button, and that means the price of the stock will be suppressed. If they like what they're hearing, they will very cautiously push the buy button and perhaps buy some stock, and then the stock might go up. So that's the process involved. And I spent, if you want to go into the vault and check my rerun from yesterday, I spent a half an hour lecturing about that, but that's what earnings season is all about. Well, I want to move beyond that. It's a very important topic. It usually lasts about a week and a half to 2 weeks, but there are other financial issues that are coming up. And the next big issue, of course, is the Federal Reserve's Federal Open Market Committee, the FOMC, is meeting again on July 30th. And this is sequential. They meet, I think, 8 times a year, with the idea of looking at the economy to decide whether the interest rates should go up or whether the interest rates should come down, and what should be done. And this is, of course, I talk about this every couple of weeks. And what they're looking at in this particular session is going to be very difficult. And let's think about why that is. We first know that the Federal Reserve, created in 1913, before electricity and automobiles, is an aged institution with a couple of mandates. We know that they are the lender of last resort. The bank gets wobbly and starts to fail. The Federal Reserve metaphorically shows up in the back door, shovels money in the bank, and Jimmy Stewart hands it out over the front counter. Everybody calms down, gets their money, and goes home. Panic is over. That was the idea of a lender of last resort, to keep the banking community from the consistent and very inconvenient bank runs that wiped a lot of people out. So that's thing one. The next is the dual mandate, which is, of course, keeping unemployment low, full employment high, and keeping the economy calm enough so that the inflation rate doesn't go above 2%-ish, maybe a little more, a little less. That's the dual mandate. And where we are right now, we've looked at the numbers last week, actually, about the consumer price index, the producer price index. And what we're seeing is inflation is bopping around somewhere at 2.4% to 2.7%. Depending if you're looking at headline or core, consumer price index, producer price index. There's a consistency in the predictivity of the numbers that suggest that we're at about pick a number, 2.5, 2.7% inflation, which is just a little over the 2% bogey where the Fed would prefer it to be. So they see a little bit of inflation in the economy. So they're going to look at that and say, well, if there's a little bit of inflation, maybe we should raise the interest rates to slow things down and get it back toward 2%. Well, when they do that, it's really an inverse relationship, or a bit of a Hobson's choice, that if you raise the interest rates to slow the economy, to lower the inflation rate, you create layoffs, because that's how you slow the economy. You slow it down, and all of a sudden people, they're getting laid off, and that will bump the unemployment rate above the magical 5%. And then suddenly we have a slower economy with higher unemployment, And that's not a good place to be. So it gets real political real fast in Congress when you look at a slowing economy and increasing unemployment. Because one thing about unemployment numbers, they translate into votes. And when people are unemployed, they tend to vote for the next guy or the other guy or the person with a better idea, or at least any other idea. And that is a political problem for politicians who like everybody happy every 2 years when the elections come around. So the point is, this is what the Federal Reserve will be looking at. And I've explained this in the past. The system, the Federal Reserve system, is comprised of 12 regional Federal Reserve banks, and those regional banks are owned by local banks in the area. And of course, they elect a board of directors, and then there's a president of the Federal Reserve Bank. And all of these banks, the 12 banks in the system, are governed by a board of governors of 7 people who are appointed by the President of the United States and confirmed for, I think it's 14 or 15-year term. It's a long term. And their job is to be the board of governors. And then if you take the 7 plus the president of the New York Federal Reserve Bank, plus 4 other presidents of the regional banks, and these rotate, that is the Federal Open Market Committee itself. And that's the group that analyzes all of the data coming in from the 12 regional banks, and that they compile it into something called the Beige Book, which is nothing more than the color of the cover back in the old days when these things were printed. But they look at the data from the 12 regions, and you try to figure out what is the sense or what is the condition of the American economy right now. Is it growing? Is it contracting? Is unemployment a big problem or a little problem? Is inflation high or low? And because the data is collected from the 12 regions, it reflects differences depending upon the region. And quite often, if you're up here in Wisconsin and we happen to have a Federal Reserve in Chicago, our economy will be different than perhaps the Miami Federal Reserve or the Dallas Federal Reserve or Atlanta Federal Reserve, because those are different economic markets. We're not a completely homogenous nation. There are some regions of the country that have a bigger economy, and some like us up here, it's kind of a smaller economy. And all of that has to be analyzed by not only the 12 people on the excuse me, excuse me, yeah, it is 12, it's 7 plus 5, the 12 people on the Federal Open Market Committee, but also the staff, and they come up with a recommendation as to whether or not to raise the interest rates or lower the interest rates. Now, I've talked about this in the past and why this is a bit of theater. And what they're deciding when they look at that data is sort of it's not clear to the average person that the Federal Reserve doesn't have some great big lever and they pull the lever back, or forward and raise the interest rates. They don't do that. What they're doing is they're looking at the interbank lending rate where banks lend each other money. And that's a very slow trickle out type theory. So if they raise the rates, it's going to trickle out over time. If they lower the rates, it's going to trickle out over time and stimulate. But it's not a magic bullet. And we have to take a break right now, but I want to talk about what they're going to be doing with respect to interest rates. So give me a minute and I'll be right back. Thanks.
Hello, I'm Brandon House. Would you like to gain access to over 20 years of my radio shows, TV shows, my books? I've written 15 books, and most of those books are ebooks now. And we have conference DVDs, conferences where we filmed our conferences at the Ozarks, literally starting 20 years ago. It's all available in our archived vault. All you have to do is go to worldviewtube.com/vault, worldviewtube.com/vault, and for a reasonable monthly fee, you gain access to over 20 years of Christian worldview programming, news, information, books, documentaries, and a powerful search engine. And folks, it's a great way not only to educate yourself, equip yourself, but it's a big way that you can help fund our continuation as a broadcast network. Please check it out. worldviewtube.com/vault, worldviewtube.com/vault, and help us continue pushing out a Christian worldview.
Okay, welcome back. I wanted to finish the thought on the Federal Open Market Committee meeting. And while they're debating the interbank lending rate, where banks borrow from and lend to each other to keep their reserves in line on a daily basis, that's a slow motion way to affect the long-term interest rates in the economy. But where the Federal Reserve has direct access to the markets and the ability to manipulate rates rather quickly is in the federal open market activities of the Federal Reserve itself. And that is conducted through the Federal Reserve Bank of New York. They have a trading desk, and there are some primary bond dealers. And effectively what happens is the Federal Reserve will go into the gigantic federal debt market, 37 trillion plus, it's all out there, and they will buy bonds and put new money into the economy and pull those bonds out of circulation, which reduces the supply of bonds available, causing the price to go up, which means the interest rate comes down. And if that's how they can reduce the interest rate, by buying bonds, putting it on their balance sheet and pumping new money in. And of course, they can raise interest rates by taking bonds off their balance sheet. And there's 6 to 8 trillion of them at any one given point in time, and do the reverse. So the Federal Reserve has the ability to very quickly, within a market trading day, change the interest rates. And we noticed that the 10-year bond, which is the bond that the mortgage industry keys off of, the mortgage rates are primarily set by the interest rate on a 10-year federal bond, and that is 4.38% today-ish, depending on when you look at it. You say, wow, well, I'd love to have a mortgage for 4.38%. If I could get that, I'd go out and buy a house. Well, it's not that simple, because this is the riskless rate of a federal 10-year treasury bond that's trading. But when you add the risk components, because interest rates are like a Viennese tort, there's layer after layer of components. You have the riskless rate, which could be the base of 4.38%, and you've got to add all the risks involved in lending money to people who may or may not be able to pay their mortgage. And that's where we get into the 7% band. And that's the risk premium for something other than a 10-year bond backed by the full faith and credit of the United States government, which means 165 million American taxpayers. So that's why when the interest rate on the 10-year is it has been in the 4s for quite some time, the mortgage rates are in the 7s. And of course, what President Trump would like to see is the 10-year down to about 2%, so that we could be seeing interest rates maybe in the 5% range, mortgage rates, and that would stimulate the housing market and take it off. And that's what he's pushing Chairman Powell to do. Hey, cut the interest rates. We're all watching the Federal Open Market Committee fiddling around with the interbank lending rates, but what you're missing is the Fed can do this tomorrow. Now, there's some yield inversion curve problems where you'd have, if you think about it, the lowest interest rate is on the shortest term, is a three-week T-bill or a 1-month T-bill. The highest should be on the 30-year bond, right? The more time, the more risk, that would be the highest interest rate. Well, instead of this cool little flat line, what you'd end up with is kind of one of these little numbers on a graph, somewhat of an internal inverted yield curve on the 10-year. And of course, markets recognize that as being a manipulation or unrealistic and temporary. So there's a real problem with trying to get the yield curve that looks like this to look a lot more like this. And that's what President Trump is pushing Jerome Powell to do. And this is getting to be a little hardball here, because I noticed a news story today that Congress is referring Jerome Powell to the Department of Justice for lying under oath during his testimony by making material false claims. So that's kind of an interesting escalation. It's one thing to ask someone to resign, and the Federal Reserve Chair says, we're independent, I don't have to, versus sending him over to the Justice Department. So we continue to watch that. But the reality is, with the mortgage rates as high as they are, we're seeing a very strong impact on the housing industry in the United States. And there's been some back and forth. I've been back and forthing with some people on X. And the issue that I have, when you look at the price of housing and you look at the take-home pay of the average American, it's startling statistics. One analysis I was looking at this morning shows a graph where in 2000, I guess about the year 2000, an average home price in America was about $200,000. And here we are today, the average price of a home selling is about $428,000. So it's like more than doubled over time. So we can see the housing prices going like this. They're accelerating on that curve. But at the same time, if you look at the take-home pay of the average American, it has been flat around 80,000, 75 to $85,000 since 1970, all the way through to 2020. So as take-home pay is flat because of expenses, inflation, and taxes, we're seeing housing prices when houses do sell at a much higher price. And that gap between the average American's take-home pay that supports a mortgage payment, not to mention the down payment, the mortgage payment, and the average price of the house is way out of whack. And of course, under traditional economic thinking, you think, well, price and, you have supply and demand, and in an equilibrium market, classic Adam Smith type market, the prices should come down because the demand isn't there. And usually that's what happens. The supply, deteriorates, the price comes down. And there's a lot of people predicting that there's going to be a collapse in housing prices. And they say, why aren't the prices coming down? And I chirp in and I say, because we're looking at the $80 to $81,000 average in take-home pay. But what you're not factoring in is the giant institutional players that are purchasing up lots and lots of single-family homes, foreign buyers who are purchasing homes. I think the Chinese were number one at 15% of the homes sold in America are being sold to Chinese people. 14% to Canadians. That's amazing. I suppose they're all buying in the Sun Belt to get out from the cold. And then the list goes down. I think there were the Mexican buyers were about 6%. The UK was 4%. So the point is, when you add up all of these foreign buyers of American homes, it sops up a lot of the, it creates excess demand that is not factored into traditional calculus. And that's why people who are saying, well, the housing prices ought to be collapsing any day now. Well, they're not. What's happening is the American take-home pay, which is necessary to support a mortgage, is not keeping up with the price because that excess demand is being driven by foreign buyers as well as institutional buyers and short-term rental buyers. It's a big thing in a lot of markets. And then the flipper business, where people will buy a home, fix it up, and sell it. There is a lot of private equity that's funding that activity, and it's not at 7%. I mean, it's going to be a 14% mortgage or loan rate. But if you're buying, fixing up, and selling, and the profit is more than enough to pay an annualized 14%, so the lenders are making a great money, and the flippers are making money, and the people who are buying the homes are paying the higher price. That's why all of these things are tied together, and it comes back to the Fed's position when they raised the interest rates, generally not by open market committee fiddling around with interbank lending, but by the activities in the open market that have created higher interest rates. And the Fed is the only entity on earth that can do that legally by printing money out of thin air, going into the market and buying bonds to keep those interest rates higher. And they can do that, or they can suppress and make them lower. And that's the monetary policy that the Fed has been given by Congress back when it was created. And that's the dual mandate. What you want to be able to do is manipulate the economy in such a way that we keep inflation low and employment high, so we have a full employment economy that's not overinflating and everybody's happy. And that's monetary policy. Well, that works, and it worked for decades. But I also submit, ladies and gentlemen, that the tools that the Federal Reserve has to use in monetary policy may not be as effective as they used to be because of the $37 trillion in debt. Now, I'm not the only commentator that has observed that and suggested that. There's been some pretty good minds out there that are looking at this phenomenon of $37 trillion in debt, and the Federal Reserve trying to step in and make interest rates change on $37 trillion is a lot more interactive than when the federal debt was $20 trillion or a billion or 5 billion. The point is, the bigger the debt pile gets, the less effective the Federal Reserve can be in dramatic changes in interest rates. And this is becoming a real problem because the Federal Reserve is our one monetary tool that could raise and lower interest rates to stimulate the economy. But if the debt pile gets too big, and I submit that it is too big, the tools don't work as well as they used to, and perhaps may not work at all. So when President Trump says to Jerome Powell, hey, you got to cut the interest rates, the answer might very well be, it's too late because you guys spent $37 trillion in debt. You're running a $2.5 trillion deficit that's going to be added to the debt. And our little old tools from, the year 1913, we're out of tricks. I mean, this is, the magic bag doesn't have any more magic wands. There's not much more we can do without dramatically impacting the rates. And that has massive effect on institutional money, like life insurance companies, pension funds, all the institutional money. There's a presumption of stability in the markets. And if that is rocked by the Fed actions to try and keep fiscal policy in check, we're going to have a real turbulent time, and that's something we should be looking at. Well, I'm out of time for today. Thank you so much for tuning in to the Eastman Financial Report. Really appreciate your viewership, and please consider making a donation to worldviewfoundation.com and keeping our ministry alive and fresh. So thank you. Have a great afternoon, and I'll talk to you tomorrow. Bye.